A lot has been happening with the Federal Reserve lately, and so today we are going to go into a little bit about what Kevin Warsh's nomination means, along with how that kind of fits into the Fed history. So Alan Greenspan once joked that since becoming a central banker, he had learned to mumble with a great incoherence. And Greenspan, who recently passed away at age 100, chaired the Federal Reserve from about 1987 until 2006, and he became one of the most influential economic figures of the last century. Whether or not you're interested in finance or economics, you have heard the name of Alan Greenspan. Hi, everybody. My name is Will Hubbard. I'm the founder of Sirius Capital. And with Greenspan's legacy back in the spotlight and Kevin Warsh having just chaired his first Fed meeting, I want to walk through what the comparison between these two leaders might tell us about how the Fed could operate in the coming years ahead. So here's the key thing to understand. The Fed has not always worked the way that it does today. And so now for the last probably 10 years or so, you've really noticed the Fed chairman come out, they do the press conference, and they give you a lot of guidance and information around what the Federal Reserve is thinking. But for much of Greenspan's tenure, the Fed didn't really even publicly announce its rate decisions. Markets had to deduce what had happened by watching the short-term rates. So watching. It wasn't that the Fed told them, hey, we're going to cut rates or we're going to increase rates, but market participants had to watch. When the Fed did communicate, that language was deliberately hard to parse. And economists, they called it Fedspeak, which Greenspan also referred to as mumbling with a great incoherence. And it wasn't until 1994 that Greenspan started to release a statement when rates changed. So think about it. We've been really used to getting all the information up front. Rates are changing. We're already talking about it with Warsh. We're expecting rates to change, right? And so that is unusual in the history of the Fed. So since 1994 and over the next 3 decades, the tools we now take for granted, that's like the press conferences that we get, the dot plots, the forward guidance, the online tools like FedWatch, where you can see basically the daily changes in the estimates of what those interest rates might be. They were developed under Fed chairman and chairwoman Ben Bernanke, Janet Yellen, and Jerome Powell. And the reason that there was more communication is really in response to crises like 2008 in 2020. So you had the global financial crisis and the COVID response where the Federal Reserve made a lot of policy shifts very quickly. And part of that was communicating it to market participants to try to ease concerns about what was going on at the time. Why are we talking about a lot about Alan Greenspan? Kevin Warsh appears to favor a lot of the aspects of the Greenspan era, which is less explicit communication, fewer policy signals, and smaller balance sheet and a tighter focus on the core mandates of the Federal Reserve. And so at his first FOMC meeting in June, he did make several notable changes. First, the Fed statement was considerably shortened. Then the forward guidance was removed, which has been a big piece of what the Fed has been telling us historically. They've been telegraphing and telling us what they are planning to do. And then not only did he remove the forward guidance, but he backed this opinion by action by not submitting his own dot to the summary of economic projections. He then announced 5 working groups to examine Fed operations. That's covering communications, data, and the inflation framework, the balance sheet, and the impact of AI and technology. And so the AI and productivity working group might be really especially interesting for longer-term investors because productivity is what lets businesses produce more with less. And over the long run, that's technically and theoretically what drives higher wages and a better standard of living for people. So technology can help keep inflation in check if it genuinely lowers the cost of producing goods and services. So let's take a step back to your macroeconomic courses from years ago and remember that the growth of the economy or GDP is largely driven by 2 main factors, which is growth in population or the labor force and the technological innovation, which we can think of as productivity gains. So really GDP is the intersection of labor, capital, and technology. So in the near term, the Fed is still managing a very challenging stretch of inflation, and the recent conflict involving Iran has added uncertainty, which is still working its way through the system. And so the latest projections are showing a divided committee. So half roughly expect rates to hold by the year end and half expect them to move higher. Another thing is the balance sheet, which is something we want to watch. So before 2008, before the global financial crisis, it stood at less than $1 trillion. Today, it's at about $6.7 trillion. That's down from the peak around $9 trillion in 2022, but it's still pretty high. Warsh supported the emergency expansions during the crisis, but has argued the Fed should have done more and been more deliberate about reversing the course afterward. So what's really the takeaway here? A Fed that gives less guidance may produce less Fedspeak, but it could also introduce more uncertainty about how or when it will respond to developments. That could affect anything that has anything to do with interest rates. So that's your bonds, that's mortgage prices, car payments, credit cards, personal loans, anything that's a borrowing cost can be affected by the interest rates set by the Federal Reserve. So here's really the bigger picture. The economy has grown across many different Fed chairs, and they've been nominated by presidents of both political parties. And that's largely because the Fed doesn't really control fundamental drivers of growth like innovation and demographics. Those attributes are not political, and they're more representative of the American entrepreneurial spirit. So the Fed is only one piece of the puzzles, which means that investors, especially longer term investors, should avoid getting hung up on exactly what is happening with interest rates. Hyperfocus on the Fed is a newer phenomenon and isn't historically something that adds value. So focusing on what you can do, review your portfolio, understand the actual fundamental risks to what you own, it's far more meaningful than whatever the current Fed is saying about interest rate developments. So if you have any questions, feel free to reach out. We'd love to chat about more about the Federal Reserve, interest rates, or your portfolio if you have any questions.